Hi, I'm Danny Michael, founder of Satori Wealth Management, and today I'm going to cover the 5 questions that you need to ask yourself before you make a Roth conversion. Roth conversions are a very, very popular tool to create tax efficient income in retirement. It's a way to essentially stretch your income as much as you can in retirement by paying the least amount of tax. And the way you do that is essentially you're equalizing your taxes throughout retirement. And in retirement, your income is going to fluctuate, and so that means there's going to be years where you're very, very low tax brackets. Then there's also going to be years where you're in much higher tax brackets. And so what you really want to do ideally is ensure that you're paying not too much tax when in those high tax years, and in those low tax years you're paying some more tax, maybe at lower tax rates, and therefore you're kind of averaging out your taxes over time. And so the 5 questions that we're going to cover today are: number one, is a Roth conversion a smart tax move right now? Two, how will a Roth conversion affect other aspects of my financial plan? Three, do I have adequate tax diversification? So we'll talk about what that means. Four, do I plan to transfer assets to the next generation? And then five, do I have enough cash on hand to pay on the Roth conversion? And so I'll address each of these questions, and we'll cover each one comprehensively. So, what is a Roth conversion? Well, what a Roth conversion is it's a way to move money from tax deferred accounts to tax free accounts. Here, looking at this diagram, these 3 triangles, and we'll start at the top. The top is tax free accounts. And you can see kind of in the middle there, the tax-free accounts are Roth IRAs, Roth 401ks, and also not necessarily an account, but a type of investment vehicle, municipal bonds. These also issue tax-free interest as well. So you can get interest from municipal bonds issued in the state that you live in. So example, I live in California. If California issues bonds to build infrastructure in the state, and I, as a resident of California, purchase those bonds, the interest from those bonds is federally and state tax free. Okay. And so with the Roth IRA and Roth 401k, the way that they work, looking at this at the diagram on the right hand side, you can see where it says after tax contributions. So the money that's going into these accounts is after taxes. You've already paid taxes on them. So think about, you work for your employer, you get your paycheck. When you get your paycheck, that's the amount that you get after taxes, right? And so you already paid tax. Then you're going to take that money, put it into a Roth IRA if you're eligible, or into a Roth 401k if your employer offers that. And then on the left-hand side, you can see that distributions from those accounts come out completely tax-free, right? So those amounts are going to come out 100% tax-free, and so they're tax-free forever. Then we have your taxable accounts to the left-hand side. And these accounts are essentially anything that's titled in your individual name, jointly, or maybe in the name of your trust. So these are going to be accounts where maybe you received after tax income. Again, you already paid taxes on income, and then you're essentially taking that money and then you're putting it into an investment account. So these are what we call non-qualified accounts. So these are not IRAs or not 401ks. They don't have any kind of tax deferral or tax-free special rules to them. So how these accounts work is that you kind of pay tax over time, right? If you get interest in that account, it's reportable in that tax year. If you get dividends from stocks or mutual funds in that account, those are taxable in that year. And then if you have a profit on a position, so let's say you buy some stock or you buy a mutual fund, it goes up in value, you sell it, you have a gain. That gain is subject to taxation in that tax year as well. And that's what we call capital gains taxes. And so you can see that, to the right, we have after-tax contributions on the right side of that triangle going in. And then the money coming out is either going to be taxed on ordinary income or capital gains taxes. It depends on, whether it's interest. Interest is taxed as ordinary income. Dividends are taxed at capital gains tax rates. I should say qualified dividends are taxed at capital gains tax rates. And then the way capital gains taxes work are if you bought a position, held it for 1 year or longer, and then you sell it, they're going to be subject to long-term capital gains tax rates, which are always going to be lower than your ordinary income, and then your ordinary income tax rate or your marginal tax rate. And if you buy and sell something within a year, then that's going to be subject to to ordinary income tax rates. It's called a short-term capital gain. And short-term capital gains are treated like ordinary income, just like income that you would receive from your employer. And then all the way to the right, we have tax deferred accounts, which most of us are familiar with. And the reason for that is because a very common tax deferred account is a 401k. Most of us, through our employers, have 401k plans, and we contribute to those plans. They're a great savings tool in the long run. It's a great way to compound growth in taxes that would have been paid, because the way that these accounts work, you look to the right of this triangle, it's pre-tax contributions going in, right? So you're not paying taxes on the money going in. So different than tax-free and taxable. So you put pre-tax money going in, and the money comes out, it's income taxable to you. So based on your marginal tax rates. So these are the three main types of accounts, essentially, where where withdrawals are treated differently from a tax saving standpoint. So tax diversification is really understanding, okay, well, having a little bit of assets in each of these accounts, right, is kind of spreading the wealth around. And so when you have, for most of us, a lot of us are going to have most of our monies in tax deferred accounts. If you've been working over the years and into your 401k, then a large portion of your assets should typically be in tax deferred, right? And so these retirement accounts, when the money comes out, and when you reach 70 and a half, or I'm sorry, 73 now is the new RMD age, what we call. So RMD stands for required minimum distributions. And so in a tax deferred account, when you reach that age, you have to start taking money out of these accounts. And you have to take them out at about 4% per year, right? Is at the first year. And then that'll go up every single year after that. The reason it goes up is because RMDs will increase as you get older every year. It's based on a table. You can Google RMD table and you'll see what the percentage is essentially you have to take out every single year. And it's also based on your account value at the end of the previous year. So, right now we're in 2023. If you look at the value of all your IRAs and 401k, simple SEP IRAs, if you have a defined benefit plan, all those types of accounts, if the total value of those on December 31st, 2022, that's going to be the amount that your RMD is going to be based on. So in your first year, let's say you turned age 73, and the amount was 4%, and at the end of last year, you had $2 million in those accounts combined, you're going to have to take out about $80,000, right? And that's all going to be treated to as ordinary income. So what a Roth conversion does is a Roth conversion will take money from the tax deferred account, and there's no limit now. There used to be a limit back was about 13 years ago, but now there's no more limit. So anyone can do a Roth conversion, and essentially what you would do is you determine the amount that you want to take out and that you want to convert, and then that amount goes from a tax deferred account to the tax free account at the top, right? So you're moving money from one account to the other. And the caveat here is when you do that, you have to pay ordinary income tax. Okay. So that's going to be added to all your other income sources. So if you're in retirement and you have Social Security and you have a pension, this amount that you're moving is going to be added to those amounts to determine your overall marginal tax rate, which I'll talk about in the next slide. And so so you have to be careful, right? And very judicious as to, okay, well, how much am I going to convert? Or is it a good idea today? Or maybe it's a good idea next year, the year after that. When you're in retirement, you're going to want to evaluate that every single year, okay? Because again, in retirement, what happens is, typically our incomes will fluctuate. You may have, spouses at different ages that retire at different times. One might still be working while the other retires. Now your income dropped. Maybe that's an opportunity. Maybe you haven't taken Social Security yet. But and then maybe next year though, one spouse will be eligible. They'll start to take Social Security. So income will fluctuate a lot in retirement, and so that's why this is a very, very useful tool. You don't have to be retired to do a Roth conversion. You can do it at any age, but it's usually a very commonly used tool in retirement because again, income can fluctuate, and for a lot of folks, especially if you retire early, you might have a lot of years where you don't really have any income. So that could be a great opportunity, to do a Roth conversion. And what happens is the money will go from the tax deferred account to the tax-free account, the Roth. You will pay the taxes on it in that year. And the benefit is all the future growth of the money in the Roth account will be 100% tax-free. Okay. So we'll talk some more about that. Now, um, the question here is a Roth conversion a smart tax move now, right? So will your tax bracket be the same or higher in the future is really the key thing to look at. So what you want to take a look at is, okay, well, if I ran out my income over the next 20 years, let's say you retire age 60, and let's say you're planning for, let's just say 30 years, okay, you're planning to age 90. So over those next 30 years, well, what does your income look like based on when do you plan to take your Social Security, if you have any pensions, when you retire, when your spouse retires, and the same questions for your spouse. What do their RMDs look like? What is their Social Security strategy going to be? And so it's really a conversation about, how all these different aspects of your financial plan work together. But ultimately, to know something today, key question: if your tax bracket is higher or the same in the future, then it might make sense to do a Roth conversion now. And the reason why is because looking at this table here, your marginal tax rate will start at 10%. Then it's going to be 12%. And 22, you can see so forth and so on, right? So, let's say this year you're going to be in a 10% bracket, right? And let's say you're married filing jointly. So let's look at that second column there. And so, in that bracket, up to 22%. So I'm sorry, up to $22,000 of income will keep you in that 10% bracket. So let's say, you don't have much income that year. This year, it's just portfolio income. And so, you're going to be in a low tax bracket. But in the future, your income is going to be in that 12% tax bracket. So then what you're going to want to maybe look at is, hey, maybe it might make some sense to convert from 22,000 to 89,000, right? So that's about, get my math here right. That is about $67,000 of income, right? You do a $67,000 conversion in the example, and that will take you to the top of that 12% bracket. That ensures that you don't pay anything more than 12% marginal tax on the conversion. And the reason is, again, you may not want to go to 22% because if you're not going to be paying 22% in the future, well, then you don't want to pay 22% now. But it might make sense to go up to that 12% bracket. Now, let's say that, another example, let's say you're in the 12% bracket now, and you're going to be in the 12% bracket down the road. The other thing to keep in mind is that, historically tax rates go up, right? In the long run, they're going to go up is what most of us assume. And so what might make some sense is to just pay some of that tax now, get some of the money out of your IRA, and part of the benefit there is that your minimum distributions down the road are going to be lower, right? So your RMDs will be lower down the road. You pay some tax now at rates that are probably going to be the same or lower than they will be in the future. And then what you're doing is not only are you lowering your RMDs, but you're allowing now this money, that 67,000, let's say, going back to that previous example that you converted, that amount now is going to grow tax-free forever, right? You never have to pay taxes on the money coming out of there. So, that's why Roths are such a powerful tool because you're not taking any kind of deduction when you make a contribution to a Roth. And when you do a conversion, you're paying taxes, right? The IRS is getting their taxes. So they're saying, okay, if you pay taxes now, we're going to allow all the money, because that money that you're putting in there is now after tax. You already paid tax on that. But we're going to allow all the growth now in that account to also be tax-free. So it's a great tool, again, to take advantage of to create some more diversification for you. And, I'll go back to the previous slide and say another thing is, if you have some money in all these different accounts, then down the road in retirement, you can really start to control your taxes, right? Because let's say you need, so going back to the other slide, let's say now, you are in the 12% tax bracket, right? Let's say you're right at $89,000. Now you're age 70, and that's all your taxes, right? Your taxable income is right at 89,000. So you're at the top of that 12% bracket. How this is going to work in real life is let's say you need to spend 120,000, right? That's your living expenses you need in retirement. You want to travel, maybe you want to help some your grandkids out, save for college. There's a lot of things that you can do there, as far as increasing your expenses. And so what you're going to want to do is if you have money in this tax-free account, you can take out $30,000. So from 89,000 to 120,000, the difference is $30,000. You can take that $30,000 out of a taxable account, maybe, or out of a Roth account, not pay any tax. And so you're not kicking yourself up into that next tax bracket. right? Where you're going to pay that 22% marginal tax rate. So this is how you're essentially equalizing your tax over time. So the next question to ask is, well, how will a Roth conversion, affect other aspects of your financial plan? So there's a lot of other things that you need to consider here. So the first thing you need to consider is your Social Security eligibility and taxability. So if you're going to do a Roth conversion, you want to keep in mind, well, when are you going to be eligible for Social Security, and when do you plan to take your Social Security, right? If you're taking your Social Security early, the earliest you can take is age 62. If you take your Social Security at age 62, well, now you have more income, right? So now that means that if you're trying to do a conversion to the top of the 12% bracket, you have less room to do that conversion, right? So you want to try to understand, really formulate a plan, a strategy that's going to go along with this Roth conversion strategy between you and yourself. So what is our Social Security strategy going to look like? Do we delay it? Do we take it at our full retirement age 67? Do we delay it to age 70? Right? These are going to be important questions to ask when you're creating your retirement plan. Once you reach age 70, then now that you can't delay your Social Security anymore, right? So now your Social Security is set, and then at that point, it may not make sense to do a Roth conversion. The other thing to understand as well with Social Security benefits is that when you have other sources of income, it can make your Social Security up to 85% of your Social Security can be subject to taxation, right? So Social Security is not federally taxable unless you have other sources of income. And most of us, those other sources of income, they're very, very low amounts, right? So if you have any other source of income, as low as it's right around 34,000 if you're married filing jointly. And once you get to kind of those, once you get to that level of income, that's when a large portion of your Social Security can be subject to taxation, right? So understanding, how Roth conversion will make your Social Security subject to taxation, depending on the amount that you do. So these are going to be important considerations to take into account before you determine, whether you're going to make a Roth conversion or not. The other thing that's going to impact, again, increases in income are going to impact for you in retirement are, let's say you retired at 60, so you're not eligible for Medicare until age 65. And let's say you have really low income. Well, you may be eligible for premium tax credit eligibility. So essentially some tax credits to offset your medical costs, right? Your medical insurance costs, your medical premiums. And so if you increase your income though, and you don't understand really how that works, you may lose all those tax credits. And then now you're gonna have to pay, premiums on your medical insurance. So that's something to take into account. And if you're over the age of 65, you may be subject to what's called IRMA. IRMA is essentially going to be, it's essentially a surcharge, an additional tax on your Medicare premiums, right? And so at different levels of income, your Medicare Part B and Part D will be subject to additional taxation. So, you may do a huge, large a Roth conversion, and then all of a sudden, a year or two later, you start to look at your Medicare premiums, and they're, a couple $100, more per month. And you're like, well, why did they go up so much? It's because of your income increase, right? So a lot of factors there to consider as to how it's going to impact other aspects of your financial plan. So another question to ask yourself is, do you have adequate tax diversification currently? And again, I talked about this a little bit earlier, but how much do you have in tax deferred accounts? How much do you have in tax free? How much do you have in taxable? He spoke with someone last week, and we talked, and this person, just turning 73, and started to realize he's a self-directed person, and he's been managing his investments for the last 20 years since he retired. And this particular gentleman, said, hey, I started to realize that now I'm going to have to start taking distributions from these accounts where I wasn't really living off this money that much earlier, right? He was taking money out of taxable accounts to live off of. So what he did was he kind of kicked the can down the road. And the problem with that, and a lot of people do this because they don't want to pay income tax. They know that when you pull money out of your tax deferred accounts or your 401k, your IRAs, you're going to have to pay income tax on that money that you're taking out. And so this is, again, why it can be beneficial to do Roth conversions earlier in retirement when you're at lower tax rates. So this particular person kicked the can down the road. He has $2 million in 401k accounts. So he knows, and then he has full Social Security, him and his spouse. They have about $60 something thousand of income there. Spouses also has a pension. So there's a pension attached with that. It's like another $30,000, right? This person already has, almost $100,000 of income, and now is going to have to take out $80,000 a year out of his 401k account. So now it's going to kick him up into those higher tax brackets we talked about earlier, and there's no way to avoid that now. At that point, right, because your Social Security will keep going up, there's a cost of living adjustment there. Your RMDs will keep going up because the markets will keep going up, right? If you have a properly invested portfolio, the value of your account should increase over time. And of course, we talked about your age. As your age, every year that you get older, um, you're gonna have to take more out of your 401k or IRA accounts, right? So what you want to do is really ask yourself, okay, do I have adequate tax diversification? So how much do you have currently in tax free, and then do you have money in taxable accounts? Because you also are gonna have to have some money to pay the taxes on the conversion when you do that conversion. Um, which kind of brings us to the next slide, right? So, well, actually be the next slide over. But another consideration, another question is, do you plan to transfer assets to the next generation, right? So you may have children or grandchildren, and those are your heirs, and they're going to inherit, most of your assets. And maybe that, well, I'm not going to spend all my money, because I don't live a lavish lifestyle, and I've saved very well. So I know my heirs are going to get, a certain amount of my estate. Or a lot of people, they have specific goals. I want to make sure my children get this amount, right, when I'm gone. I want to make sure they're able to buy a house or whatever it could be. So what's great about a Roth IRA is if you're planning on transferring assets to the next generation, is there's no minimum distributions with Roths, right? So once you pay that tax, you convert money to the Roth. The money sits there, grows tax free, and when you reach age 73, you don't have to worry about anything because no taxes come out. And a big reason for that is, the IRS already collected their taxes there. They don't really have anything to gain. So they say, okay, well, you could just keep delaying the taxes in here, deferring the taxes in here. And that's kind of, again, a big benefit of having a Roth. So, and then when you pass it to your heirs, it's tax-free savings for them as well. And so in the past, before the Secure Act, which was back in 2020, so remember, when we had COVID, there was the CARES Act and the Secure Act. Recently, the Secure Act 2.0 was passed. These legislative bills that were passed, they change a lot of tax rules and retirement rules that you need to be aware of. So in the past, what happened was, if you had a non-spouse heir and they inherited a Roth, or they inherited a regular IRA, well, they could take the balance of that. They'd have to take RMDs, but those RMDs would be over their lifetime. So if they're in their 30s or their 40s and they're younger, that amount is not 4%. It's lower because it's based on a table based on your age, right? So they could really, and realistically, if they stuck to that table, they could essentially stretch the IRA over their lifetime, right? Which is nice. You have this extra tax qualified account that you can withdraw from when you need to, throughout life. That's changed. And so what's changed is now a non-spouse heir that inherits an IRA or a Roth has to take the money out in a span of 10 years, 10 years from when they inherited. Now, in a regular IRA, what you have to be careful of is you can't wait till the 10th year, because if you do and you take all that money out in that last year, it's all income taxable. And if it's a large amount, let's say it's anywhere from $600,000 or more, then up to half of that amount could be gone, or or a large chunk of it, depending on the state you live in, because there's state taxes as well. But a large chunk of that IRA could be gone to taxes because you're kicking yourself up into these higher tax brackets. But in a Roth, because everything's tax free, you don't even have to take any money out in that first year. The heir could inherit the money. So let's say it's $500,000 you inherit as a Roth, right? You let it grow for another 10 years because it's its tax-free account, right? And you have this huge amount of money in this tax-free account. You can keep letting it grow and then wait for the 10th year and then take the money out. And you just allow all that money to grow tax-free, over a 10-year time frame. So that's a huge benefit, for a beneficiary. So, this is a great, again, Roth's a great wealth transfer planning tool when used appropriately. And you should certainly consult your financial planner or accountant, to determine whether that's going to make sense for you. So again, one thing we talked about is, I mentioned earlier, is you have to have enough cash on hand, right, to pay taxes on a Roth conversion, right? So when you do this conversion, it's going to increase the amount of tax that you have to pay in that current year, right? You have to pay ordinary income tax on the amount you convert to a Roth. So, again, going back to tax diversification, if you don't have money in a taxable account, so you don't have money in a joint account or a trust, and if you don't have money in any Roth accounts, and so all your money is in a tax deferred account, and you want to do a Roth conversion, well, where are you going to get the money to pay the taxes on? Well, again, if you don't have that money, this is going to be very, very challenging for you to do that. It might not make much sense for you to do a Roth conversion at that point, and so, you're going to have enough cash on hand to pay the tax bill. So that's another part of this equation that you're going to have to determine every single year that you're planning to do a Roth conversion, right? Let's say also that you do have money in a taxable account. So let's say you have money in a joint account or it's in the name of your trust. You have to also be aware of realizing any capital gains tax in those positions as well, because that's going to be an additional tax liability that you're going to have to pay. So not only would you have to pay the tax on converting money from the traditional IRA to the Roth IRA, you're also going to have to pay tax on, let's say you have to sell some stock or mutual funds to pay the tax on the conversion. Well, if those funds or those positions have a gain, you could also be subject to capital gains taxes as well, right? So this is where kind of tax planning gets pretty complicated. Understanding, short-term capital gains and long-term capital gains, capital losses too. In your taxable accounts, you could have losses, right? And those losses could be carried forward indefinitely in future years. So, a year like we had last year, and maybe even this year, we'll see how 2023 shakes out with the markets. But if you had taxable accounts and you're seeing a lot of fluctuation, and let's say you bought some securities and they went down in value, you want to harvest those losses. You want to sell some positions maybe and realize some losses that you can carry forward in future years to offset gains in future years. And this is how you can really start to become, a kind of a tax efficient machine by being very, very tax efficient with your investment portfolio, and then also using tools like Roth conversions and determining how you're going to withdraw money from your different retirement accounts to make sure that you're paying the least amount of tax on an ongoing basis every single year throughout retirement. And what this really entails for a lot of us is kind of running some projections of understanding what your tax liability is going to look like down the road, right? And so, if you're not sure how to do that, that's something you should be asking your financial advisor and say, hey, what are my taxes going to look like, based on me taking Social Security at 67, let's say, and my wife's going to take Social Security at 70 as an example. And here's our RMDs. We think our RMDs will be X amount down the road because here's how we're invested now. This money's going to grow to a certain amount down the road. So what would our RMDs be in the future? You have to run some projections to get a good understanding of what your potential tax brackets will be down the road. And of course, we don't know exactly what tax brackets will be in the future. No one has a crystal ball. But again, historically, tax rates go up over time. But what we do know is we know what tax rates are today. And I'll also say, by the way, based on tax rates today, is that we're in low tax rates if you look today versus where we were before 2018, right? So 2018, the TCJA bill was passed, which essentially lowered tax rates. And so that 10% bracket, 12%, those were all, and then 22%, and then 24%. Those are the kind of the first four brackets. Those were all higher brackets, right? So now we're kind of in a lower tax climate. Another thing I'll tell you about doing a Roth conversion in a year like this, where or a year like last year, where markets are volatile. If you did a Roth conversion last year at the beginning of the year, when maybe the markets were down, one thing that can happen is that if the markets go up by the end of the year, you can essentially create extra tax-free growth in your Roth through your Roth conversion. And the reason is because, if you did let's say you do a example, $20,000 Roth conversion at the beginning of last year. And by the end of the year, the markets were up a little bit. So let's say now at the end of the year, the amount that you converted, those securities that you converted and invested were now worth $25,000. Well, what you're effectively going to do when it comes tax time, the IRS is going to say, okay, you owe us $20,000 on the Roth conversion. But at the end of the year, you have $25,000 in that Roth. So you basically took out another $5,000 out of your IRA to the Roth that was totally tax-free, that you didn't pay any taxes on. So when we have market volatility, there's an opportunity potentially to have higher amounts converted that you don't pay taxes on. It's kind of a little arbitrage opportunity there. So to summarize, the factors that you really need to consider are going to be to, look at your current and future tax brackets, right? Look at your current and future income sources, right? Well, what's my income now? When do we plan to take Social Security? What about my pension? My wife's going to retire, she's going to have a pension maybe. In the future, it's going to be X amount. Or do you take a lump sum? Right. So there's a lot of decisions here that kind of affect, and that's the way just our finances work, right? It's a domino effect. Your income, your taxes, your investment, the tax efficiency of your investment portfolio, all those things are interconnected, right? And so if you make a decision in one area, it's going to impact all these other areas of your financial situation. So you can't just look at things in a vacuum. You have to look at everything together. Again, what types of accounts and amounts you have in those accounts, right? Your Roth, your IRA, and your joint. How long you have until your RMDs begin, right? So that's another thing. I mentioned the case with the gentleman I spoke with last week who just turned 73. There's really not much at that point, right? Once you reach that age, a lot of your tax planning opportunities are going to start go as far as equalizing your taxes over time. So really, when you retire, your 60s are the best time. Usually, for most of us, is going to present the most opportunity for us to tax plan efficiently, create a good tax plan to essentially equalize your taxes, so that by the time you're in your 70s, right, you're positioned to where you're not going to get kicked up in these higher brackets, right? Think about, and again, tax deferred accounts, 401ks, IRAs, they're great accounts. They're some of the best tax saving, retirement saving tools out there, right? But don't make the mistake of kicking the can down the road. Think of those accounts as kind of like a tax time bomb in a way, right? At some point, they're going to blow up and they're going to kick off a lot of income, and you could be in a position where you just pay a lot of taxes for the rest of your life that was maybe really unnecessary, right? And so it's really important to be proactive and understand when you do retire, like, okay, here's going to be our plan to maximize our income and minimize the amount of taxes that we're going to pay. And that's how you stretch out your resources throughout retirement. You know what? That's the name of the game, right? Because what's going to allow you to do? It's going to allow you to, take those better vacations, right? Travel the world. You want to live a rich retirement. Give more to your heirs, help out your grandkids, whatever it is that you want to do, right? You'll have more resources to do that. So we talked about age, and then lastly, again, a great tax planning tool, or I'm sorry, a wealth transfer tool to pass tax-free assets to your beneficiaries. So again, they can inherit these accounts, and then they can keep those accounts for 10 years, not have to take any distributions. So in a regular IRA, you have to start taking money out at age 73. Let's say you live to age 84, average life expectancies, that's 11 years. And then your heirs get another 10 years from when they inherit those assets. You've just created another 21 years of tax-free growth, right, for your heirs. So if that's something that's a goal of yours, you have some legacy goals, you want to leave your kids a certain amount of money, or you just want to make sure that, hey, we're okay paying taxes at lower rates today so that our children don't have to pay any taxes down the road. We want to set them up better. Then a Roth conversion could make some sense for you. So that's the end of our presentation. If you have any questions at all, feel free to comment in the comment section. I'll be happy to address any questions you might have. And take care until the next webinar.